Welcome to Infinite Audiobooks YouTube channel, where big ideas meet real change. If you're ready to build better habits, boost productivity, and grow every day, you're in the right place. Today's topic, the intelligent investor. Let's break it down and make it practical. Hit subscribe and let's dive in. Welcome to the ultimate guide to the intelligent investor by Benjamin Graham, the timeless Bible of value investing. Whether you're a beginner or seasoned investor, this 30-minute deep dive will give you the core principles, strategies, and mindset that have shaped legends like Warren Buffett. Let's unlock the secrets to intelligent investing. Part 1. What is intelligent investing? Benjamin Graham defines intelligent investing not by IQ or market timing, but by discipline, rationality, and a long-term mindset. According to Graham, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. This definition sets the tone for the entire book. Intelligent investing is about protecting capital and earning reasonable returns, not chasing quick profits. Most market participants, Graham argues, unknowingly speculate. They buy stocks based on price movements, rumors, or trends, without understanding the underlying business. The role of intrinsic value. At the heart of intelligent investing is intrinsic value, the true worth of a company based on its fundamentals, earnings, assets, liabilities, future prospects. Intelligent investors estimate intrinsic value through analysis. Buy when market price is below intrinsic value. Sell when price exceeds intrinsic value. This approach is counter-cyclical, buying when others are fearful, selling when others are greedy. Emotional discipline. Graham emphasizes that intelligent investing is more about temperament than intellect. Key traits include patience, waiting for the right price; discipline, sticking to your strategy; independence, ignoring market noise; humility, accepting that mistakes will happen. The intelligent investor doesn't react to every market swing. Instead, they remain grounded in their analysis and long-term goals. The allegory of Mr. Market. One of Graham's most famous metaphors is Mr. Market, a fictional character who offers to buy or sell stocks every day at different prices. Mr. Market is emotional and irrational, driven by fear and greed, often wrong about value. The intelligent investor doesn't follow Mr. Market, they exploit his mood swings. When Mr. Market is pessimistic, prices fall below intrinsic value, creating buying opportunities. Margin of safety. This principle is the cornerstone of Graham's philosophy. It means buying assets at a significant discount to their estimated value, leaving room for error in analysis. Reducing downside risk. For example, if you estimate a stock's value at 1,000 Indian rupees, you might only buy it at 700 Indian rupees. That 300 Indian rupees buffer is your margin of safety. Types of intelligent investors. Graham identifies two types. 1. Defensive investor. Passive approach. Focus on diversification and stability. Invest in index funds, bonds, blue-chip stocks. 2. Enterprising investor. Active approach. Seeks undervalued stocks through deep analysis. Requires time, effort, and skill. Both can be intelligent. What matters is choosing the path that suits your temperament and resources. Long-term focus. Graham warns against short-termism. Intelligent investing is about holding quality assets for years, ignoring daily price fluctuations, letting compounding work over time. He famously said, "In the short run, the market is a voting machine. In the long run, it is a weighing machine." This means short-term prices reflect popularity, but long-term prices reflect value. Intelligence is behavioral. Graham redefines intelligence in investing. It's not about being smarter than others. It's about being more rational and consistent. It's about controlling your emotions, not predicting the future. Warren Buffett, Graham's most famous student, echoed this. Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get others into trouble. Summary of key principles. Invest, don't speculate. Focus on intrinsic value. Use a margin of safety. Be emotionally disciplined. Think long-term. Choose a strategy that fits you. Part 2. The concept of value investing. Value investing is the practice of buying securities that appear undervalued based on fundamental analysis. The core idea is simple. Buy a dollar for 50 cents. This means purchasing stocks when their market price is below their intrinsic value and holding them until the market corrects the mispricing. Why do stocks become undervalued? Markets are not always rational. Stocks can be mispriced due to negative news or temporary setbacks, market overreactions to earnings reports, investor herd behavior, economic cycles, or sector downturns. Value investors see these moments as opportunities, not threats. How is intrinsic value calculated? Intrinsic value is the true worth of a company based on its fundamentals. To estimate it, value investors use earnings, net income, EPS, earnings per share, assets, book value, tangible assets, cash flow, free cash flow, operating cash flow, growth potential, future earnings projections, valuation ratios, price to earnings, PE, price to book, PB, discounted cash flow, DCF analysis. These tools help investors determine whether a stock is cheap or expensive relative to its actual business performance. The margin of safety. Benjamin Graham's most powerful concept is the margin of safety. It means buying well below intrinsic value, leaving room for error in analysis, minimizing downside risk. For example, if a stock's intrinsic value is 1,000 Indian rupees, a value investor might only buy it at 700 Indian rupees. That 300 Indian rupees buffer protects against misjudgments or market volatility. Value investing is contrarian, buying when others are fearful. Growth investing often follows momentum. Famous value investors. Benjamin Graham, father of value investing, author of The Intelligent Investor. Warren Buffett, Graham student, CEO of Berkshire Hathaway. Charlie Munger, Buffett's partner, known for mental models. Seth Klarman, hedge fund manager, author of Margin of Safety. Christopher Brown, value investor and author. These investors have consistently outperformed markets by sticking to value principles. The psychology behind value investing. Value investing requires emotional discipline. Ignore market noise. Resist fear and greed. Stay patient during downturns. Think independently. Markets often overreact. Value investors profit by staying calm and rational when others panic. Strategies in value investing. 1. Deep value. Buying stocks trading far below book value. 2. Dividend value. Focusing on high-yield, stable companies. 3. Contrarian investing. Buying unpopular or distressed stocks. 4. Quality at a discount. Buffett's approach, great companies at fair prices. Each strategy requires thorough analysis and a long-term mindset. Common metrics used. P/E ratio. Lower P/E may indicate undervaluation. P/B ratio compares market price to book value. Debt to equity measures financial stability. ROE, return on equity, indicates profitability. Free cash flow shows how much cash a company generates. These metrics help identify financially sound companies trading below their worth. Patience is key. Value investing is not about quick wins. It's about buying undervalued assets, holding through volatility, letting intrinsic value be recognized over time. It may take months or years for the market to correct mispricing, but when it does, the rewards can be substantial. Summary of core principles. Buy below intrinsic value. Use a margin of safety. Rely on fundamental analysis. Ignore market noise. Be patient and disciplined. Think long-term. Part 3. Mr. Market, the emotional investor. Who is Mr. Market? Benjamin Graham introduced Mr. Market as a fictional character in The Intelligent Investor to personify the irrational behavior of the stock market. Mr. Market is your hypothetical business partner who shows up every day offering to buy your shares or sell you his at wildly different prices depending on his mood. He's not rational. He's not consistent. He's emotional, moody, and unpredictable. Mr. Market is there to serve you, not to guide you. Benjamin Graham. Mr. Market's personality traits. Mr. Market behaves like someone with manic depressive tendencies. Euphoric, overvalues stocks during bull markets. Depressed, undervalues stocks during bear markets. Impulsive, reacts to headlines, rumors, and short-term events. Erratic, offers prices that swing wildly from day to day. He doesn't care about fundamentals. He's driven by fear, greed, and herd mentality. How Mr. Market affects stock prices. Mr. Market's emotional swings cause overvaluation. When optimism runs high, prices soar beyond intrinsic value. Undervaluation. When pessimism dominates, prices fall below intrinsic value. These fluctuations create opportunities for intelligent investors who remain calm and rational. How to deal with Mr. Market. Graham's advice is simple. You are never obligated to accept Mr. Market's offer. You can buy when Mr. Market is pessimistic and prices are low. Sell when he's euphoric and prices are high. Ignore him when his offers don't align with your analysis. The key is to treat Mr. Market as a tool, not a teacher. The psychology behind Mr. Market. Mr. Market represents the collective emotions of investors. His behavior is shaped by news cycles, economic data, geopolitical events, social media hype, speculative bubbles. Most investors follow Mr. Market's mood. Intelligent investors exploit it. Real-world examples of Mr. Market's mood swings. COVID-19 crash, 2020. Market plunged nearly 40% in weeks. Panic selling dominated. Value investors bought quality stocks at deep discounts. 2008 financial crisis. Global meltdown triggered fear. Mr. Market slashed prices irrationally. Those who bought during the panic saw massive gains in the recovery. Chipotle's E. coli scare. Stock crashed due to health concerns. Fundamentals remained strong. Investors who bought during the dip profited as the brand recovered. Warren Buffett on Mr. Market. Buffett calls Chapter 8 of The Intelligent Investor, where Mr. Market is introduced, the most important part of the book. He says, you should imagine market quotations as coming from a remarkably accommodating fellow named Mr. Market, who is your partner in a private business. Buffett's success is built on ignoring Mr. Market's emotions and focusing on business fundamentals. Lessons from Mr. Market. 1. Don't follow the crowd. Herd behavior leads to bubbles and crashes. 2. Stay rational. Base decisions on analysis, not emotion. 3. Be patient. Wait for Mr. Market to offer attractive prices. 4. Use volatility to your advantage. Buy low, sell high. 5. Focus on intrinsic value, not daily price movements. Summary of key takeaways. Mr. Market is a metaphor for the stock market's emotional behavior. He offers prices based on mood, not logic. Intelligent investors use his irrationality to their advantage. Emotional discipline is essential. Long-term thinking beats short-term reactions. Part 4. Margin of safety. The investor's safety net. What is margin of safety? The margin of safety is the difference between a stock's intrinsic value and its market price. It acts as a buffer against errors in judgment, market volatility, and unforeseen risks. The margin of safety is always desirable because valuation is an imprecise art. Benjamin Graham. If you estimate a stock's intrinsic value at 1,000 Indian rupees and buy it at 700 Indian rupees, your margin of safety is 300 Indian rupees, or 30%. Why it matters? Markets are unpredictable. Even the best analysis can be wrong due to economic downturns, management failures, regulatory changes, global events. The margin of safety reduces downside risk and increases potential returns. It's not just a cushion. It's a core principle of intelligent investing. How to calculate it? To apply the margin of safety, investors. 1. Estimate intrinsic value. Use methods like discounted cash flow, DCF, earnings multiples, or asset-based valuation. 2. Compare to market price. If the market price is significantly lower than intrinsic value, the stock may offer a margin of safety. 3. Set a threshold. Many investors, including Warren Buffett, Look for a 30 to 50% discount to intrinsic value before buying. Qualitative and quantitative factors. Margin of safety isn't just about numbers. It includes quantitative, earnings, assets, debt, cash flow. Qualitative, management quality, competitive advantage, governance, industry trends. Combining both gives a more reliable estimate of intrinsic value and a more meaningful margin of safety. Real-world example. Imagine a company with intrinsic value, 500 Indian rupees per share. Market price, 300 Indian rupees per share. That's a 40% margin of safety. If your valuation is off by 20%, you still have a buffer. If the market corrects, you stand to gain significantly. Emotional discipline required. Margin of safety works only if you resist buying overpriced stocks. Stay patient during market hype. Avoid chasing momentum. Stick to your valuation framework. It's a tool for rational decision-making, not emotional investing. Warren Buffett's take. Buffett calls margin of safety one of his cornerstones of investing. He often applies a 50% discount to intrinsic value before buying. His success with Berkshire Hathaway is a testament to this principle. Key takeaways. Margin of safety protects against valuation errors and market risk. It's calculated by comparing intrinsic value to market price. A larger margin means lower risk and higher potential reward. It requires patience, discipline, and rigorous analysis. Part 5. Defensive versus enterprising investor. Benjamin Graham, the father of value investing, categorized investors into two broad types. The defensive investor. Definition. A defensive investor seeks stability, simplicity, and safety. Their goal is to avoid major losses and minimize the need for constant decision-making. Characteristics. Prefers blue-chip stocks, index funds, or ETFs. Avoids speculative or volatile assets. Focuses on long-term, steady growth. Makes infrequent portfolio changes. Values diversification and capital preservation. Ideal for beginners, busy professionals, risk-averse individuals, those seeking peace of mind over high returns. Mindset. The chief emphasis is on the avoidance of serious mistakes or losses. Benjamin Graham, the enterprising investor. Definition. An enterprising investor is proactive and analytical, willing to put in the time and effort to uncover undervalued opportunities. Characteristics. Conducts deep research and financial analysis. Invests in undervalued stocks, special situations, or growth companies. May include real estate, startups, or alternative assets. Accepts market volatility as part of the game. Seeks above-average returns. Ideal for experienced investors. Those with time and skill for analysis. Individuals comfortable with risk and complexity. Mindset. The goal is to achieve a higher than average rate of return. Graham. Values diversification and capital preservation. Which one should you be? Ask yourself, do I have time and interest in analyzing stocks? Am I comfortable with market fluctuations? Do I prefer simplicity or control? What are my financial goals and timeline? There's no better choice, only the one that fits your personality and circumstances. Graham's advice. Graham emphasized that most people should be defensive investors unless they have the temperament, time, and skill to be enterprising. He warned against overconfidence and chasing returns without proper analysis. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. Enterprising investor strategies. Graham outlined 4 areas where enterprising investors can outperform. 1. Buying in low-price markets and selling in high-price ones. 2. Investing in growth stocks with strong fundamentals. 3. Finding bargain issues, undervalued stocks. For special situations, mergers, spin-offs, distressed assets. Final thoughts. Whether you're defensive or enterprising, success comes from discipline, consistency, understanding your limits, sticking to your strategy. Both paths can lead to wealth if you walk them wisely. Part 6. Portfolio strategy. Building wealth with discipline. What is a portfolio strategy? A portfolio strategy is a structured approach to selecting, managing, and adjusting a mix of investments to achieve specific financial goals while balancing risk and return. It's the blueprint that guides how you invest your money over time. The essence of investment management is the management of risks, not the management of returns. Benjamin Graham. Objectives of a portfolio strategy: preserve capital, generate returns, minimize risk, achieve long-term financial goals, adapt to changing market conditions. Graham's core principles. Benjamin Graham emphasized simplicity, discipline, and rationality in portfolio construction. His strategies are built on diversification. Avoid putting all your eggs in one basket. Asset allocation. Balance between stocks and bonds based on risk tolerance. Margin of safety. Buy assets below intrinsic value. Periodic rebalancing. Adjust holdings to maintain target allocation. Defensive investor strategy. For the defensive, passive investor, Graham recommends 50% stocks / 50% bonds as a baseline. Adjust between 25% to 75% in either, depending on market conditions. Focus on high-quality, dividend-paying stocks. Use low-cost index funds or ETFs. Avoid frequent trading. This strategy prioritizes capital preservation and steady growth. Enterprising investor strategy. For the enterprising, active investor, Graham suggests seek undervalued stocks using fundamental analysis. Consider special situations, e.g., mergers, spin-offs. Use contrarian thinking to buy when others are fearful. Be selective and patient. Avoid speculative or trendy stocks. This strategy aims for above-average returns but requires time, skill, and emotional discipline. Key components of a portfolio strategy. 1. Asset allocation. The mix of asset classes, stocks, bonds, cash, etc., based on your risk tolerance and goals. 2. Diversification. Spread investments across sectors, geographies, and asset types to reduce risk. 3. Rebalancing. Periodically adjust your portfolio to maintain your target allocation. For example, if stocks rise and become 70% of your portfolio versus a 60% target, sell some and reinvest in bonds. For risk management, use stop-loss orders, position sizing, and margin of safety to protect against losses. Example portfolio strategies. Defensive portfolio. 50% in index funds, e.g., Nifty 50, S&P 500. 30% in government or corporate bonds. 10% in dividend-paying stocks. 10% in cash or liquid funds. Enterprising portfolio. 40% in undervalued stocks. 20% in growth stocks. 20% in special situations. 10% in bonds. 10% in cash. Final takeaways. A portfolio strategy is your roadmap to financial success. Choose between defensive or enterprising based on your temperament. Focus on diversification, asset allocation, and risk control. Rebalance regularly and avoid emotional decisions. Let your strategy evolve with your goals and market conditions. Part 7. Emotional discipline, the investor's inner game. What is emotional discipline? Emotional discipline is the ability to remain calm, rational, and committed to your investment strategy, especially during market volatility. It means resisting impulsive decisions driven by fear, greed, panic, or euphoria. The investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham. Emotional investing versus rational investing. Emotional investing often leads to buying high and selling low, while rational investing aims for buying low and holding long. Common emotional biases. 1. Loss aversion. Fear of losing money outweighs the joy of gains. Investors may sell too early or avoid good opportunities. 2. Overconfidence. Believing you can time the market or pick winners consistently leads to risky behavior. 3. Herd mentality. Following the crowd during bubbles or crashes, often at the worst time. 4. Recency bias. Giving too much weight to recent events, ignoring long-term trends. 5. Confirmation bias. Seeking information that supports your beliefs, ignoring contrary evidence. How to build emotional discipline. 1. Have a long-term plan. Create a clear investment strategy aligned with your goals and risk tolerance. Stick to it. 2. Use asset allocation. Diversify across stocks, bonds, and cash to reduce emotional reactions to volatility. 3. Practice masterly inactivity. Sometimes, the best move is no move. Avoid reacting to every market swing. 4. Automate decisions. Use systematic investing, e.g., SIPs, rebalancing schedules, to reduce emotional interference. 5. Track performance rationally. Review your portfolio based on metrics, not headlines or gut feelings. 6. Learn from history. Understand past market cycles and investor mistakes to avoid repeating them. Historical wisdom. Roman general Fabius Maximus defeated Hannibal by waiting patiently. Masterly inactivity. Jack Bogle, founder of Vanguard, advised, "Don't do something, just stand there," during market panic. Muhammad Ali's rope-a-dope strategy in boxing mirrors the idea of absorbing volatility without reacting. What happens without emotional discipline? Panic selling during crashes locks in losses. Chasing hot stocks leads to buying at peaks. Overtrading increases costs and reduces returns. Abandoning strategy causes long-term underperformance. Part 8. Lessons from Warren Buffett. Warren Buffett, the Oracle of Omaha, is widely regarded as the greatest investor of all time. His success isn't just about picking stocks. It's about discipline, philosophy, and temperament. Let's explore his most enduring lessons, many of which echo Benjamin Graham's principles, but are refined through Buffett's own experience. 1. Invest in what you understand. Buffett's golden rule: never invest in a business you cannot understand. He avoids complex or speculative businesses. Instead, he focuses on companies with simple, predictable models like Coca-Cola, Apple, and American Express. This principle, known as staying within your circle of competence, helps reduce risk and improve decision-making. 2. Be patient. Let compounding work. Buffett's wealth is largely the result of time and compounding. He started investing as a teenager and held many of his best stocks for decades. The stock market is a device for transferring money from the impatient to the patient. He doesn't chase short-term gains. Instead, he allows businesses to grow and compound value over time, often holding through recessions and volatility. 3. Margin of safety is non-negotiable. Buffett inherited this principle from Benjamin Graham. He always seeks to buy stocks below their intrinsic value, creating a buffer against errors or market downturns. Example: in the 1970s, Buffett bought shares of the Washington Post at a deep discount. Over time, the company's value soared, and his investment multiplied many times over. 4. Ignore Mr. Market's mood swings. Buffett uses Graham's metaphor of Mr. Market, a fictional business partner who offers to buy or sell shares at irrational prices. You don't have to trade with him. Just take advantage of his foolishness when it suits you. During market panics, like 2008 or 2020, Buffett often buys great companies at bargain prices while others are selling in fear. 5. Focus on intrinsic value, not market price. Buffett distinguishes between price and value. Price is what you pay. Value is what you get. He evaluates businesses based on their cash flows, competitive advantages, and long-term prospects, not short-term stock movements. 6. Buy quality businesses at fair prices. Buffett evolved from Graham's cigar butt investing, buying cheap, dying companies, to buying great businesses at reasonable prices. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. He looks for companies with strong brands, loyal customers, and durable competitive advantages, what he calls economic moats. 7. Emotional discipline is everything. Buffett's temperament is his superpower. He avoids emotional decisions, resists market hype, and stays calm during crashes. Success in investing doesn't correlate with IQ. What you need is the temperament to control the urges that get others into trouble. He practices masterly inactivity, often doing nothing when others are panicking. 8. Stick to a system. Buffett recommends that most investors use low-cost index funds and follow a disciplined system. A low-cost index fund is the most sensible equity investment for the great majority of investors. Even though he's a stock picker, he believes that systematic investing, like SIPs, helps avoid emotional mistakes and ensures long-term growth. 9. Invest in yourself first. Buffett often says the best investment you can make is in your own skills and knowledge. The more you learn, the more you earn. He took public speaking courses early in life to improve his communication skills, an investment that paid off in building trust with partners and shareholders. 0. Be contrarian. Think independently. Buffett's most famous advice: be fearful when others are greedy, and greedy when others are fearful. He made some of his best investments during market crashes when others were selling in panic. His contrarian mindset helps him find value where others see risk. Thank you so much for listening. Your time and attention mean a lot, and I hope this journey through The Intelligent Investor gave you something valuable, whether it was a fresh insight, a new perspective, or just a moment of clarity.